Join us now for the rest of the show is Rick Rieder, Chief Investment Officer of Global Fixed Income at BlackRock. I think of, I don't know, the movie Airplane, where I picked a bad day to predict higher rates, coronavirus, right? I mean, it's just, higher rates cannot get out of their own way. Maybe they just don't deserve to go higher in the current environment.
I mean, it's historic what we're going through. We're going to be in low rates for a long time. You got a couple of things, let alone what the Fed's doing, the liquidity coursing its way through the system. The demographic is so powerful, the need for assets, particularly this time of year. Insurance companies, pension funds, rates are going to stay low for a long time. By the way, Europe and Japan are still not growing. They were not creating the inflation, so they're going to have negative rates there for a long time. So no, we're going to be at low rates for a long time.
Global pandemic notwithstanding, it still makes sense. Maybe it may be influenced by 10 or 15 basis points, but we're only at 180, and then on the 10-year.
Listen, if you go to stability and the tail risk driven by the virus goes away, could rates move up? Should they move up another 15, 20 basis points? They should. Real rates are too low in the U.S. today. That being said, we've talked about this. We've added some duration. We've added some interest rate exposure on the long end of the curve because with this out there, it actually works as a pretty good hedge against your risk assets. But the demand for income, the demand for assets, this is generational. I think we've talked about it on this show for years. We're going to be in a low rate paradigm.
What do you mean rates are too low here? They're lower everywhere else than they are here, so maybe they're too high here.
Well, so if you but inflation, you've got reasonable inflation.
You sure?
It's not, you're running, let's say, depending on how you measure it, close to 2. Core PC is still around 160. But it's reasonable inflation. So then you put real rates on top of that and say, gosh, real rates are flat to negative. That's not very interesting from where you take risk. What do you think the term structure of interest rates? So they're okay. Should they be a bit higher? They should be a bit higher. Are they going to get there? Really hard, because the demand for income, the demand for assets is multiples bigger than the supply.
And what you said there about it operating as a hedge is interesting, because you'd have a window on this based on flows, right? The higher stock markets go, the world is plugged into an asset allocation model in aggregate, totally, and you have to add to fixed income.
People don't realize, when they look at the flows, you see the outflows that you saw from the equity markets, and it goes into the bond side, exactly what you described. When equities go up 25, 30%, you now are off balance. You now have to rebalance out of equities into bonds. So you get this cyclical, pro-cyclical dynamic that the more that rates are low and the more it drives the equity market higher, that money's got to go back into bonds. It is an amazing thing. People don't talk about that. To keep a 60-40 balance, you need to keep buying bonds.